Hi everyone, welcome to Master Key Associate. This is a response to the clarion call for IAS 7 Consolidated Statement of Cash Flow. I have received your messages, your text, so here come group cash flow statement. Perhaps you are having difficulty of any kind. Just please calm down. Okay, subscribe to this channel. Drop a lovable message to keep us burning for you, okay, and press the like button. When you subscribe, that qualifies you for subsequent publications or presentations. Is that clear? So, group cash flow or consolidated cash flow statement. Let's have a recap. IAS 1, the presentation of financial statements, okay, talks about the basic components of a typical financial statement. 1. The statement of profit or loss and other comprehensive income. 2. The statement of financial position. 3. The statement of cash flow, IAS 7. 4. The statement of changes in equity. The last, the notes to the financial statement. These are 5 components, the make up, okay, of financial statement. And among these 5 components, cash flow statement is carved out and is treated separately because of its importance, effect on an organization. Is that clear? So IAS 7 is the principle, is the ultimate standard that regulates the statement of cash flow, whether a single cash flow statement or consolidated or group cash flow statement. IAS 7 is the standard that regulates that. Is that clear? That regulates that. Okay. Okay, so what are those things? Okay, what are those things that would that we need to consider? See, everything you have learned, right, under the single cash flow statement is 100% relevant. Remember that the total cash flows activities can be classified into 3. Number 1, cash flows from operating activities. 2, cash flows from investing activities. 3, cash flows from financing activities. All these 3 components are still applicable to the group cash flow. Also, the template, the format given to you for a single cash flow is still the same thing you are going to use for this group. However, little adjustments will be made to that single cash flow format. Okay, so please, I want to seek your indulgence. I want to appeal to you to understand the single very well, because I am going to simplify this for you. It will just be a walk away without any stress. Exactly. So welcome to consolidated cash flow statement or group cash flow. Now, when we talk about the group cash flow, okay, the group cash flow is a cash flow of the parent company and its subsidiary presented as one. Exactly. Presented as one. Now, we are going to consider these cash flows under 3 or 2 headings. Basically 2 headings. Okay, 2 headings. Don't let me go further. Okay. Acquisition, when the parent company acquires a subsidiary, okay, and when the parent company disposes a subsidiary. So let's see now. Acquisition. of subsidiary. Okay, when the parent company acquire the subsidiary. Is that clear? So you will know in the question. Hello. One thing about group cash flow is that you are not going to be left in vacuum. You will be told. Hello. You will be told. Oh, acquisition of subsidiary or disposal of subsidiary. Exactly. So now, when there is an acquisition of subsidiary, right? What are the what are the adjustments you need to watch out for? What are the basic adjustments you need to watch out for? Please just pay attention. I know most of you are challenged by this group cash flow. I will show you a simplified therapeutic path that you are going to follow. So number one, let's talk about the basic adjustments. Okay, the basic adjustments that you should watch out for. Number one is what? Is goodwill on acquisition. Are we there? Remember that in a single cash flow, when you are using the indirect method, you will say profit before tax, abi, and you will add back depreciation, impairment, and amortization. These are non-cash items. So goodwill too is under impairment. So we need to test, is there any impairment on the subsidiary goodwill? Is that clear? So this is what you are going to do. So you are going to calculate your goodwill. Class, the essence of finding the goodwill is to help you determine, please hear me, is to help you determine if there is an impairment. Because if there is an impairment, obviously you are going to add back, okay, to the group profit before tax. So, and determination of impairment. Now, let's now find out the goodwill. Calculation of goodwill on acquisition. Exactly. Remember, what is goodwill? The purchase consideration minus what? The fair value of the subsidiary identifiable net asset. Now, and you know that under IFRS 3 business combination and IFRS 10, okay, consolidated financial statement, okay, that the goodwill is the purchase consideration minus the fair value of the net asset. Okay. Okay, so we know that goodwill is the purchase consideration of the parent company, okay, less the fair value of the subsidiary acquired net asset. Now, under partial consideration, what is partial? When the parent company did not acquire the whole of the 100%, like you acquired 80%, then you know that the 20% is for the NCI, or you acquire 70%, then you know that the 30% is for the NCI. So in this case now, the purchase consideration would be the parent company purchase consideration plus the NCI value, okay, on the date of acquisition. So under group cash flow, okay, mostly the parent company okay, consideration would be cash consideration, okay, that is where the parent company transfer cash, okay. It could also be share consideration, where the parent company gives its shares as part of payment. This will always be what be measured at the fair value, at the what, at the fair value. That is, you are going to use the parent company market value. Also, you also have deferred consideration, okay. Here what you are going to use what, the PV of the deferred consideration. Lastly, you could also have contingent consideration. Contingent consideration, okay, according to IFRS 3 and IFRS 13, is measured based on the fair value. So class, of course, I don't expect any question to give you all this in the group cash flow. Here we are saying this could be some of the purchase consideration of the parent company. So now if you add up now, here you will have the total purchase consideration of the parent company. Now add the NCI. Now remember the NCI, okay, at what, DOA. Now you all know that the value of the NCI on DOA can be calculated in two ways, either based on fair value or based on the proportionate share of the net asset. So you will have to find out the value of the NCI based on the policy of the NCI measurement. Sometimes the fair value of the NCI on DOA, that is the value of the NCI, might be given to you. Check the questions very well. If it is given to you, just okay, pick it, okay. If fair value, okay, if given, let's see, anyway, let me just add, okay. If you have the fair value, just pick. So if you add up now all this, you have the total purchase consideration. I would recall we are trying to find the goodwill on acquisition. So let's now, the net asset of the subsidiary, okay, the subsidiary acquired. Class, we are doing what, consolidated cash flow statement, okay, and we are under when the subsidiary is acquired. So they will give you the net asset. So here you have the goodwill on. So class, remember my people that the essence of this thing is to help us see, is there any impairment, okay, because under the cash flow, okay, the indirect method, you will say profit before tax, right? You will add back all the non-cash items like depreciation, impairment, amortization, loss on disposal. Is that clear? So because this is a group cash flow, okay, and it involves acquisition of subsidiary, so let us determine, okay, is there any impairment loss in the subsidiary? So we have gotten now, okay, the goodwill, the goodwill now on acquisition. Class, what is next now is there any impairment? Okay, is there any impairment? So that impairment is our focus now. Are we there? So now, determination of impairment. Loss. Now, to determine the amount of impairment, now you are going to make use of the goodwill account. Remember, goodwill account. Goodwill is an asset. Okay, it's an asset. Therefore, you must start with the debit balance. Okay, use the goodwill account. Goodwill account. And as you all know, class, that you'll be given 2 years balance sheet. Abi, you'll be given 2 balance sheet. Okay, in this case now we are doing group. Okay, you'll be given 2 consolidated statement of financial position. You'll be given. So go to the opening one. What is opening? Let's say now you have 2019 and 2020. 2019 is the opening. Go to your non-current asset and see the value of your goodwill. You will say balance of the goodwill brought down. Okay, brought down. Now plus what? Good. Okay, plus what? Plus goodwill on acquisition. Okay, on what? On acquisition. The subsidiary you acquire now. Okay, that goodwill you got there, you are going to add, right, to increase the value of the goodwill. Now, what is a closing balance now? Say balance carry down. So you close the account. Now this total, okay, minus this, here you have impairment. Okay, or what? Or goodwill written off. Exactly. This is the balance you need. Okay, now that is the impairment or the goodwill written off. Where are you going to use this? You are going to add this back, okay, to profit before tax under operating activities. So that is what you are going to do in that regard. So class, so this is what now? The impairment, okay, loss, or the goodwill written off. Now this will be, okay, will be added to the profit before tax under operating activities. Okay, you will add it back, right? Not add impairment or goodwill written off back to profit before tax under operating activities. Exactly. You are going to add it back. You can say so. That is that. Next now is the dividend received from associate. Okay, is what is the dividend, okay, received from associate. Exactly. The dividend received from associate. 2. Dividend received class. you all know that associate is always considered to under group account, okay, under group account. Now, just like as you have investment in subsidiary, okay, you also have what? Investment in associate. How would you know? Hear me, I have told you that don't be scared. How would you know if you are going to do this? Look at your consolidated profit or loss, okay. If you have share of profit from associate, you know it's always there. If you have it there, okay, then you should know that you are going to do this adjustment, because dividend from associate is cash flow under investing activities. You have invested now, abi now, and you don collect dividend, so e dey come under your investing activities. But you need to watch carefully the income statement. Do I have anything there that has to do with associate? So if you have now, you are going to find what is the amount of dividend the parent company actually received from associate. Now, to do this now, okay, what is the account you are going to use? Remember, when we did associate, okay, IAS 28, in your balance sheet, okay, there is what we call investment in associate. So you are going to go to your two balance sheet, your consolidated statement of financial position, okay, under the non-current asset, okay, for the 2 years you will have there your investment in associate. That is what you are going to use to determine the actual amount of dividend you have received from associate, okay. So let's say now, here use your investment in associate, okay. Let me come here, I can manage the board very well. So you are going to use your investment in associate to determine the dividend you have received. Investment in associate. You know that investment in associate is an asset. Is that clear? It's an asset. So because it's an asset, you are going to start from the debit balance, okay. You will start here. So the balance brought down, okay, the balance brought down, the balance brought down, okay. Now secondly, go to your P or L, okay. Look at your share of what? Of associate profit. Your share of associate profit from the P or L. Share of you add in the income statement, you add. Now, what is the closing balance now? Okay, the closing balance of your investment in associate. You use the closing balance. So we close now. We close. You add this up. Now, this, okay, minus this, here you have dividend received from where? From associates, okay. The balance figure. Exactly. You have what? You have the dividend received from associate. Class, this is what is cash inflow under investing activities, okay. Note, this is treated as cash inflow under investing activities. Exactly. So the dividend received from investment in associates is cash inflow under investing activities. Does that make sense? What next now? Is the dividend paid by the subsidiary to NCI. Okay, the what? The dividend paid by the subsidiary to NCI. The dividend paid by the subsidiary to who? NCI, to your non-controlling interest. Now, you know NCI is not a member of the group. Is that clear? That is why we always show the value of the NCI separately in the balance sheet. Okay, so we need to know what is the dividend paid by the subsidiary to the NCI. You are not concerned about that of the parent company, because that is an intra-group transaction and that must have been knocked out before they prepare the consolidated financial statement. So your focus is on the dividend paid by the subsidiary to the NCI. And in order to do this now, which account are you going to need? You are going to make use of the NCI account. Okay, the NCI account, your non-controlling interest account, is what you are going to make use of, okay, to get this value. Remember that your NCI account is like your share capital account, okay, because it represents the capital of the NCI. So you are what going to start with the what? With the credit side. You see the balance brought down. Okay, the balance brought down. Out there, the balance brought down. Okay, so that is that. Also, so you say the balance brought down. Okay, now do you remember that there is also an NCI, okay, in the subsidiary you just acquired? Okay, there is also an NCI in the subsidiary you just acquired. Now you also see add NCI in subsidiary what acquired. Okay, right? The NCI of the subsidiary you just acquired. Now you are also going to add that. See, NCI subsidiary acquired. You know we are talking on when there is an acquisition of what? Of subsidiary. Okay, so say balance of the NCI. Okay, you will get this under the equity section of the account. Okay, so they add now NCI of the subsidiary acquired. This will increase the value of the NCI at the beginning. Exactly. Now here you have now. Also go to the P&L. Okay, look at what is the amount of share of profit for the period that is given to the NCI. You also add here, go to the P&L, the P&L account, NCI share of what? Profit. Okay, for the year you also add. That is all you need. Okay, now come here. What is the closing balance of the NCI? Balance carried down. So you sum up this minus this. Okay, here you have dividend paid to NCI. This is a balancing figure. It is treated as cash outflow under financing activities. Exactly. So that is what is the amount of dividend. Okay. Note, this is treated as cash outflow under financing. Okay, financing activities. Exactly. So that is that. Okay, so what next again do you need to do as adjustment? Now, what is the actual amount we pay to acquire the subsidiary? You know that when the parent company acquire, you pay, right? And we need to know the amount of cash that we pay. We are only considered with the cash element because we are dealing with the cash flow statement. So the actual net cash that we pay to acquire the subsidiary, that will come under investing activities because you are investing as cash outflow. So let's see that now. That be 4. Calculation of cash paid to acquire subsidiary. So what is the cash paid? Okay, here. What is the cash paid here? Now, remember, under the purchase consideration, okay, there, check. The parent can pay cash share differ. You only pick the cash aspect only. You only consider the cash aspect only because we are dealing with cash flow statement. So here you see the purchase consideration. Okay, parent consideration. Parent will the cash only. The cash only is what you are going to consider. Okay, the cash aspect only is what you are going to use. Now, when you acquire the asset, hear me, they will give you the PPE, the cash, the bank, the liability and everything. So when you acquire the asset, okay, you also take over certain cash and bank balances. You are going to take away the cash and the bank. Okay, you will see less cash balance. Okay, cash, okay, balance of subsidiary acquired. You also want less bank balance of subsidiary acquired. Now you now add now, okay, add what? Add bank overdraft. Okay, you add the bank over because you also acquire the liability. So add bank overdraft of what? Of the subsidiary acquired. You add this, okay? You now add now net cash paid. Net cash paid to acquire the subsidiary. So that is a net cash paid, okay, that used to acquire the subsidiary. Class, this is what is treated as this is treated. The net cash paid is treated as cash outflow under investing activities. You can see as cash outflow under investing activities. Okay, that is what you do. As cash outflow under investing activities. That is what you do. Is that clear? So, what next again? Unity. Now, you know, when we are dealing with the group cash flow, okay? Excuse me. So class, you know that when we acquired, okay, subsidiary, we actually take over some assets and some liabilities. And you also remember that under cash flow statement, okay, under the indirect method, we talk of changes in working capital. You hear me? When you acquire the subsidiary, okay, all the assets of the subsidiary will be added to the asset of the parent company. 2, all the liabilities too will be added. Is that clear? So we now want to see the movement in the working capital, okay, that we are going to use for the cash flow. So you add all the assets, okay, and you also add all the liabilities. So this could be the last adjustment I will show you, okay, why I will demonstrate the rest for you in the course of the calculation. So the fifth one now, okay, calculation of changes in working capital. Now, you know, working capital is current asset minus current liability. So I am going to first deal with the aspect of the current asset. Let me see. 1. Okay, the current asset. Meaning what? Changes in the current asset. Okay, changes in the current asset. Out there. Changes in the current asset. So now you are going to bring down. Let's assume that here we have Here we have inventory. Okay, trade receivables and order so you know you have acquired subsidiary now, okay, right? Okay, and you want to see the movement in the working capitals. You know, we always do it current assets separately and the current liabilities separately. So you are going to add all the current assets you acquire here, okay, first. Now say balance brought down, okay, the opening balance of the current asset of the parent company. Now add subsidiary acquired. What are the current assets of the subsidiary you acquired? Let's say I have inventory, okay, I have trade receivables, I also have this. You add, okay, you add to the opening balance, okay, of the parent company this. So here you have adjusted opening balance. You see, so you are going to add in that manner. Now less now the closing balance. Less closing balance. Less the closing balance. Now you have here this could be increase or decrease out there. Okay, you know that an increase is treated as cash outflow, okay, as cash outflow, okay, as cash outflow. So let me do this way. Let me put the increase first because I want you to understand it carefully. Very well. Let me see. Okay, increase. Okay, increase. Increase out there. So it's treated as cash outflow. Here you have increase. Slash what? Slash decrease. So increase, okay, in working capital in the current asset is cash outflow. You can see the same pattern of what you have learned before is what you are applying. So let's go now to the aspect of the current liability. I want you to grab it carefully. So this is what this increase or decrease goes to the operating activities under changes in working capital. Okay, note this increase slash decrease go to operating activities under changes in working capital. Is that clear? That is how you roll. So that is that. We look at the last one now, okay? The last one, and is okay, operating activities. So the increase or decrease in the current asset, okay, go towards operating activities under changes in working capital. Is that clear? That is good. So the last one, okay, is the current liability aspect of it. You are also going to do the same thing. You will start with the opening balance of the parent's current liability and also add the current liability of the subsidiary you acquired. Let's see that too. So class, now also let's look at the second aspect too, okay, of the changes in working capital. Okay, you know, we have looked at the current asset aspect of it. So let's look at the current liability part of it as well. Here I will call it, that is 5, okay, 5II, 5II, okay, right? So changes in current liability current liabilities. Okay, now like I told you earlier class, you are also going to add the acquired current liabilities of the company, of the subsidiary, to that of the parent company, except the bank overdraft. Because you know that we don't even consider the bank overdraft when we are doing the working capital, because the bank overdraft is considered in the calculation of the cash and cash equivalents. So other payables, so the bank overdraft is only considered in the calculation of the cash and cash equivalents. Okay, so but you consider other liabilities acquired by the parent company from the subsidiary. There you have the balance brought down. The balance, okay, brought down. These are the parent company current liabilities balance, okay. The one of the first year brought down. Now add subsidiary acquired. Do we also acquire the trade payables and the other payables? Here you are, adjusted opening balance, adjusted now. You now less now the closing balance. Okay, you less the closing balance. Okay, you know that this is a liability. Okay, an increase, okay, is cash inflow. Why would decrease in cash outflow? Okay, so you less the closing liabilities. So you may have this, okay, an increase, decrease, an increase, decrease. Okay, okay, increase, okay, increase slash what, decrease. So this represent cash flows under operating activities in changes in changes in working capital. Out there. So that is that. So the last one now, okay, we have to do with the cash received, okay, under the financing activities. Okay, cash received under the financing activities. So now says now cash received okay from the issuing of shares now. You know, under the financing part 2, you need to know, is there any cash received, okay, by the parent company. So here you are going to use the share capital account, okay, the share capital account. See, you know, share capital account is a liability account and has a credit balance, right? So you will say balance brought down, right? Balance brought down. Now you will add together the ordinary share, okay, the ordinary share account, the share account, the ordinary share, okay, plus what, the share premium, okay, you add together. The ordinary share capital account, okay, the ordinary share plus the share premium, you add together. Also in this year too, okay, in this year too, okay, in this year too, has there be any share issue by the parent company? Yes, you may check if parent company has issued shares as part of its purchase consideration. You will say here now, add share what consideration, okay, the amount of the share value, the fair value, okay, out there. So here you have now the balance brought down. The balance brought down. The balance brought down. That will be the ordinary share capital plus what? The share premium. Again, the closing one, you also add together. So this, okay, minus this. If this is more than this, so this is called the cash receipt. Okay, cash received, the balance. So this is what, and this is a cash inflow under financing activities. It will be the cash inflows. Okay, it will be cash inflow under financing activity. The cash received represent cash inflow under financing activity. So I think we are going to stop here, okay, and let's take a typical exam question to illustrate. Okay, thank you. Stay tuned, please. Okay, class, so let's start, okay, and look at question 6. Jackson PLC. Jackson PLC. Here you have the draft consolidated financial statement, okay, of Johnson PLC group are given below. You have there the consolidated statement of profit or loss and other comprehensive income. Is that clear? You can see the revenue, the cost of sales, gross profit, and all that. And the other comprehensive income, there is a loss on property revaluation, 2.5 million. Take note of that. And the profit for the period attributable to NCI and owners of parent company. Lastly, total comprehensive income attributable to NCI and owners of the parent company. Is that clear? So here you also have consolidated statement of financial position for the opening year 2005 and the closing year 2006. So note now, note 1. During the year ended, a plant was disposed at a loss of 320,000. Anyways, let us skip that. You have note A, note B, note C, note D, note E. You can see that note E, okay, shows that this is an acquisition of subsidiary. On 15th May 2006, Johnson PLC bought 75%, you can see, of the equity share of Jackson. So Johnson PLC, okay, is Johnson PLC. Johnson is the parent company. Bought what? 75% of the equity share of Jackson. For how much? Okay, the consideration was furnished through a share exchange of 10 million ordinary share of Jackson and an immediate cash payment of 22 million. The market price of Johnson PLC share on 15 May 2005 was 75 kobo. Okay, now the net asset of Jackson PLC as at the date of acquisition, you can see, is what? 34,350. You can see that is the net asset. What is net asset? The current asset less the current liability. Exactly. So that is 34,350. Note F. It is the policy of the group to measure NCI shareholders using the full goodwill method. At acquisition, at acquisition date, the fair value of the NCI in Jackson PLC is 8.8 million. It is 8.8 million, not 8.5 million. Required Prepare the consolidated statement of cash flows for Johnson PLC Group for the year ended 31st December 2006. You know, you are going to use indirect method here, class. And under your indirect method, what are you going to start with? Your profit before tax, abi? Your profit before tax. Our profit before tax. So here we say profit before tax. Go to the consolidated P&L. That is what? 84,900. 84. You know, under single, you also start with the PBT for indirect, okay? After this, what are you going to do? You are going to add back, right? All the non-cash items. First, add back. Add back, okay? Add back non-cash items. Like what? Your depreciation, okay, impairment, amortization, loss on disposal. So let's check now, class. What do you have here? Okay, don't let me go this way so that I don't make it this for you. Now, you know, I want to be taking you through now the single cash flow we did so that you can get clear. You know, once you get this, okay, class, what are you going to do? Add back your depreciation, impairment, loss on disposal, and the finance cost. Does that make sense? So you add all this back because finance cost is not an operating activities. Okay, so here add back depreciation. Okay, how much is that? Let's check. Depreciation. Look at note 1. Okay, note 1. During the year ended, a plant was disposed at a loss of 320. Okay, we are also going to add back to loss on disposal 320. Okay, 320. The carrying amount of the plant at disposal was 1.5 million. The loss on disposal had been charged to the cost of sales. We are going to add that to loss on disposal. We are coming there. B. A property was revalued upward by 2.5 million due to a fall in the market value. Sorry, was revalued downward, okay, downward by 2.5 million due to a fall in the market price of the property during the year. The total depreciation charges for the year is 3,350,000. You add 3 million you do that, okay? First, 3,350,000. Also, that note 1, add what? Loss on disposal. Because that must have reduced the profit. So 320, okay? 320. Adding bin, it is profit on disposal, you are going to subtract, okay? but you add loss, you less profit. Does that make sense? Okay, next now, look at that. So we have treated that depreciation, loss on disposal. Okay, now what of the finance cost? Yes, go to your P&L. Finance cost is how much? 15,550. You also add back 15,000. Now, having done this class, this is an acquisition of subsidiary. As you can see now, group cash flow. You have treated what you have on the profit or loss statement. Okay, there is still one, the investment income, which we are going to less, because investment income does not belong to operating activities, it belongs to investing activities, but we are coming there. Let us determine, is there any impairment of goodwill written off? Okay, before I treat that investment on investment in on the investment income. Okay, so let's do that now. To calculate the goodwill on acquisition, okay, the first adjustment, what is one? Goodwill on acquisition. Is that clear? Now, the parent company consideration, I told you in this question, okay, the parent paid cash and also what, issue shares. I mean, how much was paid in cash? The cash consideration of the parent company was 22 million, and issue was 10 million shares. Share consideration, 10 million shares. Okay, 10 million shares at what price? At the parent company market price, 75 kobo. Out there, yes, that is what, 7.5 million. You add, then you have total. Okay, you add. Okay, if you add this, so these two, okay, if I add now is good, but I may choose not to add. Okay, so this, the sum of these two is the parent company purchase consideration. Exactly. Okay, exactly. So now, what is the NCI value? What is the value of the NCI? You know, I told you earlier, okay, that the value of the NCI is determined by the parent company's policy. And in this case, in the last note, I think note E, let's take. Yes, note F, it is the policy of the group to measure NCI using full goodwill, and the NCI, okay, at DOE is 8.8 million. Please class, it is 8.8 million, not 8.5. okay, it's an error. So add now NCI value, okay, at what? At DOE, fair value given 8.8 million. So you add back, okay, to get a total purchase consideration. That will be 38 million. So total purchase consideration. Now let's now the net asset of subsidiary, the net asset, excuse me, of subsidiary acquired. That's how much. Look at that note, where you have the list of the net asset is what? 34,350, 34,350. So let's here you have goodwill on acquisition. That's how much? 3,950,000. Class, that is the goodwill. But our aim is to see, is there any impairment? The movement on the goodwill. So now to get the impairment now, determination of impairment. So you are going to use the goodwill account. So the goodwill account, I told you that what goodwill is an asset account. So you start with the debit balance. Go to the to the first year, 205, is the opening year, 205. Say balance brought down is how much? 35,000. Now also what? Add now, add the goodwill of what the subsidiary was acquired is what? 3,950. So what is the closing balance now of the goodwill? Go to your account for 2006 under your balance sheet, non-current asset. You are having 3,650. So it's very simple. You add up here, you have 38,950. This minus this, here you have what? The impairment. Impairment value or goodwill written off. How much? 2,450. This is the balancing figure, the goodwill written off. So, and you know that this is a non-cash expense. So we are going to add back to the profit before tax. I hope you can see the flow. It's very, very easy. So here we have 2,450 as an impairment or goodwill written off. 2,450. Add impairment of goodwill, or goodwill what? Or goodwill written off. 2,450. See now, why I have to do this? Because it deals with acquisition of subsidiary. What next now? Go to your income statement. Here you also have investment income of 12,140. Obviously this is not an operating activities item. What are you going to do? Less investment income. This you go to invest in. Is how much? 1,000 So it's 12,140. 12,140. So let us do that. Here we have 94,430. Class, what is this called? Operating cash flows before changes in working capital. Decide not to, okay, put that caption, okay. That 9,000, that 94,430 is called operating cash flows before changes in working capital. And if you like, don't put the caption, okay. You go ahead. Let me see. Operating cash flow before changes in working capital. Before changes in working capital. So after this now, what is the changes in working capital? So changes in working capital I told you working capital is the current asset minus current liabilities. So you are what? You are going to look at the current asset part first. Look at your trade receivables, inventory, and other receivables. Please do not touch cash or cash equivalent or bank. You only need to touch your trade receivables, your inventory, and other receivables. And then also remember that this is an acquisition case. So you are going to add the current asset of the subsidiary to the opening balance of Johnson, okay, first. Okay, like I showed you in the format earlier. So let's come here and do that as well. Okay, so now working capital task 2. Changes in working capital. No, I told you you are what? You are going to start with the what? With the current asset first. So changes in the current. Now, what are the current assets, okay, of Johnson PLC? They are the current asset of Johnson PLC. Here you have what? You have inventory, I mean. You have inventory and what? And trade receivables. Inventory and trade receivables out there. Now go to 2005. Look at the opening balances of Johnson, the parent. Say the balance brought down, okay? The balance brought down, excuse me. Is what? 101,250. There you have 98,500. Now add now, okay? What? Add subsidiary. Add subsidiary acquired. Go to the net asset of this subsidiary you acquired. Do you have inventory there? Yes, you add 17,250. Also, you have the 6,008 for your trade receivables. You add up. Here you have 118, okay, 500. Here you have 105, okay, 300. This is called adjusted opening balance. Less closing balance. Okay, less closing balance. Okay, less closing balance. So go to the account of 2006 now. Okay, here I have 112,750. Here I have 120,500. So you know that what that an increase in the current asset is cash outflow, while what decrease is cash inflow. This minus this, okay, is what is decreased. You have 57. This is what is an increase, 15,200. Okay, increase in jacket slash what decrease. So you add decrease and you less increase. That is that about the current asset aspect. Also the current what liabilities too, sharp. Okay, changes in current liability. Changes okay. So what do you also have there? Go to the account of Johnson. Here I have trade payables, and other payables. I told you that you don't use bank overdraft or loan, because the bank overdraft is used for the cash and cash equivalent, while the loan is used to determine the financing cash flow. So what is the balance brought down of Johnson? Go to the account of 2005. Here you have 1407 141070. Here you have 71900. Add to that the current liabilities acquired, okay, from the subsidiary. Add subsidiary acquired is what we have here, 63 for trade payables. Here there is nothing here. So here you have 71900. Here we have 147 what 70. Here you have adjusted opening balance. Adjusted what opening balance. Now go to the closing now account of Johnson and compare the closing with that. So less closing balance, okay. Then you have 81,600. Here you have 52,950. You know, the way you do for current asset is not the same with this. Now an increase between the opening and closing of current liability represents cash inflow, while decrease is cash outflow. So this minus this, okay? 147,377 minus 81. So here we have 65 what 770. That is what, that is cash outflow, okay? It's a decrease, decrease. Why these two, okay? Less these two, right? You have 1,895.50. Both of them are decreased. They are cash outflows. Flows. There you see decrease. Yes, decrease, okay? Decrease. So they are cash outflows. Meaning what? Part of the outstandings have been what? Paid. Yes, if you are having this before and you are having this at the end, it means you have paid part. You are having this before, you are having this at the end, you have paid part. So that is that. So we can go now and put it in the cash flow and move on. You can see it's very, very simple. So now here we have the first thing, what is increase in what? Okay, we have decrease in inventory. Okay, add decrease in inventories. Okay, that's how much? 5,750. Let's increase in trade payables, 15,200. Now for the current liability partner, okay, both of them are what? Are decreased. So they are cash outflow. So let's decrease to, sorry, here should be trade what? Trade receivables. Thank you. Let's decrease in trade payables is decrease 565 65770. Also let's decrease to in other payable. This 18,950. So this now we have that, okay, to get what? To get our cash flow from operating after changes in working capital. So now all this now, okay, say this plus this less this. There you have cash flows. Let's see, operating cash flows after changes in working capital. Okay, so there you have what? You have 260. Now the last thing is what? Is to less our income tax. Okay, less our tax paid. You know, this issue of finance cost, IAS 7 has given us two options. You either use it under operating or under financing. Exactly. So consistency is the key. So I like to use it under financing activities. That is why I am not going to deduct financing cost here. Okay, but I will take it to financing activities because it makes sense. Okay, it's a cash flow that what relates to finance. So what is the tax we paid here? The tax we paid. So if you check your balance sheet, I told you, just like you did under single, if you have any information there as per the current income tax payable and deferred tax, so it means the tax you have in the P&L is not cash. You have to do your adjustment to get the actual amount of tax paid in cash. This is cash flow statement. So we are only concerned about the cash movement. So let's go and do that right away as workings. So what is the cash, the tax paid now? Okay, workings for tax paid. So you are going to open taxation account to know the actual amount of cash paid as tax. You know, this is a liability account too. So you start from what? From the credit side. You should have gotten used to this logic. So the balance brought down. Now look at your balance sheet there. Go to the current liability and the non-current. You have deferred tax and the current tax. So you are going to use both. Okay. Now deferred tax liability, the current tax liability under the opening 2005. Now here you have 22,800. Here you have 34,410. Had it been you don't have deferred tax, then you are good to go with the current tax, okay, in the current liabilities. Now, did you acquire any tax from the subsidiary? Yes, tax. Okay, tax of the subsidiary acquired. Okay, it's how much? 1550. So now, you know, is there any tax too paid in the P&L? Check. Tax in profit or loss, that is in the income statement. There is in profit or loss. It's how much? 37,500. So now come here and say my balance carry down now. Okay, the same deferred tax liability for closing, the same current tax for the closing. There you have 21,470. There you have 38,000. 8,000. So you close this like this, my people. This together you have 92,260. So this is more than this. So the balance you have here is the tax paid. Okay, the cash paid as tax. The cash paid as what tax is how much? 36,790. So that is what we go now to the operating activities. Okay, the cash paid. Yeah, we go in there and put that. What? 36,790. This less this, okay, obviously is what? Negative. So that is net cash flow from operating activities. Net cash flow from operating, let's make here A is what? 36,530. In jacket. That is that about operating. Now is investing activities, okay? Investing activities. Investing. Remember that there you have investment income, okay, received in the P&L. That we let's here is what? 12,140. Okay, that come here, investment income straight away. $12,140. So it means it is in cash, because there is no any further information as to whether part is in cash or part is in accrued. Okay, so now you know this is an investment. Now when you get to this place under group cash flow, ask yourself first, what did I pay as to acquire the subsidiary? Okay, the purchase consideration used to acquire the subsidiary is cash outflow under investing, because you are investing. So let's come and determine that right away. So the purchase consideration 5. Okay, let's see, cash paid to acquire subsidiary. You know, it is a parent consideration only the cash element only, and it's how much there? 22 million. Now there is no cash or bank as part of the asset of the subsidiary acquired, but you have the bank overdraft. Okay, you add bank overdraft of the subsidiary acquired. Is how much there? Is 1.6. There you have 23, okay, 600, okay, as my cash paid to what? To acquire the subsidiary. So that is an outflow under investing activity, because you are investing. Okay, had it been I acquire cash or bank as part of the asset of the subsidiary, you are going to subtract. But here I don't have any cash item there, but I only have bank overdraft. That is why you must pay attention to the first part of this video. So subsidiary now, okay, acquired. Okay, acquisition of subsidiary, you paid what? 23, because you are paying is outflow 23 what? 600. Now after this class, you know, on a norm under a single cash flow, once we get here, okay, you focus on the movement in the non-current asset, whether current asset has been acquired or not. But because this is a group cash flow, so this is an additional adjustment. The cash paid to acquire the subsidiary. So let's now go back now to the normal thing by looking at, is there movement in the non-current asset? That is, do we purchase any asset during the year? Be careful, no question will tell you that they purchase so asset, especially under this investing. You have to always test that by yourself. I have told you, you have to test that by yourself. The examiner will hide this from you. They will not tell you the asset acquired during the year. It is your responsibility to determine that. So now let us get that now, okay? The acquisition of PPE. Let's check that. Of property and plant equipment. I have told you, either single or group, always determine this by yourself. Now in this case, now you can see all the assets are given together. They are called PPE. So you are going to use it that way too, as the PPE, property, plant and equipment account. You know, this is an asset, okay? It is not given in kele form. So they are grouped together. So you start from the debit side. The balance brought down in the 2005 account is 480 330. Exactly. Yes. Now, I told you earlier that whatever comes here, okay, will increase the value of the asset. But whatever comes here will decrease the value. Now, do we have any asset acquired? Okay, because this is a case of acquisition of subsidiary. So, the PPE you also acquire. The PPE of what? Of subsidiary, okay? Of subsidiary. The PPE of subsidiary acquired of the subsidiary is how much? 25,500. Okay, great. Over there. Yes. Go to the subsidiary net asset you acquire. Is there. Now, is there any disposal? Note one. Yes. Disposal are the carrying value, okay? An asset that has what? A carrying value of what? Of 1.5 was disposed. Okay. Also, depreciation charges. You know all this, okay? 500. 3, okay, 50. Last, what next? There is a revaluation decrease. How do I know this? Loss. Go to the other comprehensive income. There is a revaluation loss of 2.5. How do I know? Go to the equity side, okay, of the balance sheet. Look at the revaluation surplus of the 2005 with 2006. It has what? Decreased from 15,200 to 12,700. Here you have revaluation decrease, okay? You have 15,200 minus 12,007. Here you are having 2.5, okay? If it's an increase, it will come here, as you know. Last, now, what is the balance carry down? The balance carry down. The balance carry down go to the closing PPE 510 200. So you add this up, then you have 517 550. So this minus this, okay, here you have 11,720. Here it is the cash you paid to acquire another PPE. Okay, I told you no question will show you. You have to always do this. Okay, now what, we have spent 11,720 now to acquire another PPE. So it's cash outflow under investing activities. So acquisition of PPE or purchase of PPA. Okay, 11,720. Working is what here? Working 6. Here is working 5. Okay, is that all? Look at the class. We also have a case there, a very funny case. Disposal. See, you know, the cash from disposal of PPE should come as cash inflow under the investing activities, while the cash paid to acquire PPE should come as cash outflow under investing activities, and other investments too that you acquire apart from the cash equivalent. Exactly. So there is a note here, note 1. Listen. During the year ended, a plant was disposed at a loss of 3.2. Okay, the carrying amount of the plant at disposal date was 1.5. The loss on disposal are been charged to cost of sale. Fine, what a good story. You dispose plant at a loss, but we did not know the actual cash received from the disposal, and the cash from disposal constitute cash inflows under the investing activities. So let us say now to determine the cash actually received, because this question is very funny. It only told us that the plant was disposed at loss. Fine, that story is good. How much is the cash actually received? We don't know. So let us go and work it out. Adding the cash received is mentioned. Just pick that and add and walk away, but the cash is not mentioned here. So let us do that now right away. So note 7, okay, note 7, cash proceed from disposal, right? From disposal of plant, right? Of plant. Class, I want to walk you back now mathematically, because here we are told that what we sold that thing at a loss, but what is the cash received? We don't know. Now, since it is at a loss now, okay, since it's at a loss now, okay, let us use mathematical, okay, way to get the actual cash received. Now you say loss on disposal. You know, for you to get loss on disposal, it means what? The carrying value, okay, must be what? Must be less than the sales price. Abi? Yes. The carrying value must be what? Less than the what? That is than the sales price. Yes. Sales price. Right? For me to get loss, so the carrying value of the asset is what? Less than the sales price. So I will make the sales, okay, price here as my X. So what is the loss here? Is what? Is 3.2, I mean 3.2, 320,000. 320,000 is the loss on disposal. See oh, this very funny question. And what is the carrying value in the word question? Is 1.5. 1.5. This I don't know, and I want my S. If I say 320 minus 1.5, here what? Minus X. My S is my sales price. So this minus this, right? Here we have minus 1180 minus S, exactly. So this minus cancel minus my S now, which is what? My S now, therefore my S is a sales proceed is what? 1180. So that is a cash, okay, I received from the sales of the asset that resulted in loss of 320. What a funny question. Okay, add proceed, proceed from disposal of plant working is what? Working 71180. So what do we add there? If we add that up, you are having 22,000 in jacket. Net cash flow from what? Investing activities. B. So now the last line is financing. We are going financing. So next line is what? Is financing activities. So financing. You know, the cash flows here has to do with all our financing issue, okay? With all our financing issue. Now, the first thing there is what? Is our finance cost, abi? Since there is no any further information, I have told you, if there is no any information in the balance sheet or in the note, okay, as regards the finance cost, so it means what? The one you have in the income statement is the actual cash paid. Is the actual cash paid. So we are going to come now and less, okay, the finance cost. Finance cost. Finance cost. 15 what? 5. 15 550. Since there is no any further information, so it means what we have there is the actual amount of cash paid. Now after this now class, let's see, is there any cash receipt? Because financing activities has to do with how we raise cash from issue of shares or debt instruments. So let's see, is there any cash receipt, okay, during the year from issue of shares? Remember, this is acquisition of subsidiary, and we have issued shares to subsidiary as purchase consideration at the market price. Definitely the value of the shares would have increased. So we are going to do that right away. So let's see that now, okay, to see if there is any cash receipt from shares. Note what? Note 8. What means 8? Cash proceed from issuing of what? Of shares. Whether single or group, you are going to do this. you compare the share capital and premium at the beginning with the closing to see. But in this case is what is the case of subsidiary acquisition. So I am going to show you a T format to share capital account. No, this is what liability account. So you have to start from the what, from the credit side. Okay, the balance brought down. Now here I said you are what, you are going to add together the opening share capital and the share premium. If you check there, here you have 100,000 as share capital and 40,000 as share premium. You have 140. You have 140,000. Is that clear? You have 140,000. Okay, now did you issue any share this year? That will be here. Yes, we issue share as part of the purchase consideration, so it will increase the share. Share consideration is 7.5. Okay, then the balance here, the balance carry down. Okay, now what is the balance of your share capital? Go to the account of 20 OCs. Is what, 180,000. 180,000 is 180,000 plus a closing share premium 75,000. The same thing. That will be 255,000. 255,000. Over there. So let's close now. If this is more than this, so it means what? We have received cash, we have issued shares. 255. This minus, okay, this. Here we have 107,500. There's a cash received. Cash received. Okay, we have issued share because this is more than this. This will appear on the debit side of our bank or cash book. Exactly. 25. So that is a cash we received, okay, from the issue of what? Issue of shares. From the issue of shares. So it was, we received 107,500, okay, dread as cash proceed. So proceed from issue of shares 107,500. Okay, 107,500. That is a proceed. What next now? You also go to your what? You also go to your non-current liability to also check if you have also raised money through any loan. Okay, you know, you check your share capital and your non-current liability. If you have raised money through any loan, you also do that too. So let's check that too. As working is 9. Yes, working is 8. Working is 8. Working is 8. 107. 107. So what means 9 now? Let's do that. What means 9? So look at the loan. Have we raised money from any loan? Let's check. Long-term loan. Long-term loan. This is what? This is a liability account. So you have the word credit balance. The balance brought down. Look at the account of 2005. It's how much there? It is 85 650. Do we also acquire loan? Yes. Subsidiary loan acquired. So the subsidiary loan acquired, right, is what? Is 5,570. Sorry, 5,750. And the balance of the loan for 2006, 129,500. So let's check if we have received cash. 129,500. Okay, obviously is what? More than these two. It means we have what? We have raised money from loan. We have received cash from loan. 38. Okay, 100. Okay, cash received from loan. You know, this will be on the debit side, Abby, of the cash book or the bank. Aha, is on the credit side there. So we have received cash from loan. So here we say proceed, Abby, from loan. From loan. $38. Proceed from loan. Loan. Workings 9. It's an inflow 38100. Now, what is the amount of dividend paid by the parent company? Let's check. Actually, in the note, it is there that what? That the parent company paid 17.5 million as dividend. So that is an outflow. Dividend paid by the parent company to its own shareholders now, okay, to the shareholders of the parent company. Also, what is also is the dividend paid to the NCI. Dividend paid to NCI. Dividend paid to NCI. Let's see that as working 10. As working 10. As working 10. To do that, okay, you are going to make use of your NCI account. So dividend paid now by the subsidiary to the NCI, you are going to make use of your NCI account like I showed you earlier. Dividend paid to NCI by who? By the subsidiary. The NCI is not part of the group. So you have the non-controlling interest You know, it's like your capital account, so it has a credit balance. Over there. So, what is the balance brought down? Go to the what account of 2005. Okay, 5. The account of 2005. Okay, the balance brought down. There you have the balance brought down is what 147,500. Now, is there any NCI acquired in the year? Sorry, it is 421. Okay, 41200. 41200. Add what? NCI of subsidiary acquire, because that will increase the balance of the NCI. This 8,800. Then any NCI share of profit. NCI share of profit. Okay, 3,550. Then the balance of the NCI will come here. The balance as at 2006, 50. So you close now. This add together, you have 53,550. This minus this, okay, you are having 3.5. As well as dividend paid. Dividend was paid cash. Over there. So that is what the dividend paid to the NCI. Okay, so that will serve as cash outflow under financing activity. So dividend paid to NCI is 3,500. 3,000. So what is the net cash flow now from financing? Okay, that will be 15. Let's see, 107,500 plus 38,100 minus 15,550 minus 17,500 minus 35. I have 109,50. 109. 10905. It's called net cash flow. Net cash flows from what? From financing. Activities. I'll make it C. C, okay? From what? From financing. One 09050. Make it C. No, we have E and B and C. This labeling is advisable to help you. Okay, to help us. So now at the end of the year, we want to see, okay, the increase or decrease in cash and cash equivalent. From what? From operating, we have this jacket, this policy. If you add together, that will be 520, 50, 520. 50, 520. Okay. Increase or decrease in cash and cash equivalent. Here you have increase or decrease in cash and cash equivalent. Okay, and cash equivalent. Now, what is our cash and cash equivalent at the beginning? Hope you remember at the beginning. Our cash and cash equivalent at the beginning. So that will be note 11. Cash and cash equivalent. Cash and cash equivalent. Okay, now you are going to do for the 2 years. You have 31st December 2005, 31st December 2006. Okay, is your cash, bank, short-term investment, less bank overdraft. Now here we only have what? We have cash at bank and the short-term investment. So cash at bank, go to the parents company account, is what? 5,000 for the first year. What's closing? 10120. 10120. Also there we have short-term investment. You also add short-term investment. Is how much? 28,100, 32,250. Now less the bank overdraft. Exactly. That is why bank overdraft is not used under working capital. It is used under the cash and cash equivalent. Less bank overdraft, less bank overdraft. For the first year you have 48,850. Here you have 72. So what is our cash and cash equivalent? Both at the beginning, at the end. Then you have 15350. Okay, 350. Here is what? Here is jacket, Abi. Jacket. Here you have 35,170. So our cash and cash equivalent, okay, at the what beginning is jacket, is negative. So let us treat that right away. So now your cash and cash equivalent at the beginning. Cash and cash equivalent at the beginning is what? 15,350 jacket. If you subtract, okay, you will have 35,100 170. Okay, you will have 35 170. Let me do that up here. Let me see. Here you have 35 170. Chai. Okay, let me do that up. So the cash and cash equivalent at the beginning is minus 35. Sorry, minus what? 15,350. Okay, minus 15,350. 15,350. So this minus this, okay? This minus this, okay? You must have the closing as a what? Cash and cash equivalent of 35 170. Exactly. If you say 50,520 minus 15,350, you must have the closing cash and cash equivalent of 35 170. Let me confirm that too. 50 minus 520, sorry, 50,520 minus 15,350. Yes, you have 35 170 is balanced. Here you will put cash and cash equivalent at the end equals to 35 170. Is that clear? So this is the end of this question. This is the full question on group cash flow, okay, on the acquisition of subsidiary. No question should go beyond this on acquisition. It has a lot. So thank you very much. God bless you. I wish you all success in your exam by God's mercy and grace. Thank you, and thank you. You will see the video soon.